radio for a really great future. We're talking real money.
Hey there. Thanks for joining us on Talking Real Money. Tom Cock here, Don McDonald with the day off. Roxy joining us here on the show. We'll talk with her in just a moment. But first, there's a fairly famous line from one of the early Star Wars movies where Obi-Wan says, talking about Darth Vader, more machine than man. I always like that line. In fact, I saw a friend over the weekend who's had like 11 surgeries or something, and he's a great athlete. This one of these guys, really good. And I use a line, I'm like, you're more machine than me. He thought it was funny. I think it's funny. But when it comes to your money, I'm going to ask you right now, would you rather have a machine picking stocks or would you rather have a human being picking stock? Which would be better?
I think a combo.
I didn't prep her on this either, by the way.
I think a combo, right?
Combo.
Use the technology available,
Okay.
but always,
But who would do better, and who do you think would be the better stock picker, the better investment manager? Would it be artificial intelligence or would it be human beings?
It depends who's creating the artificial intelligence code.
That's what I was thinking, too. But okay, so there's a couple of things recently that I just want to talk about briefly before we get to the questions. And thank you for your questions. You go to talkingrealmoney.com and ask us questions there. There's there's a new study out. Stanford's Terminator AI just beat 93% of the human fund managers using just public data. In other words, anything that was out there, they built a bot. It retro tested more than 3,300 mutual fund portfolios from 1990 to 2020 and outperformed 93% of their human managers after adjusting each fund every quarter. Now, there's some caveats here. We don't have to get into all that, but they just used the information and they went in and traded and did better than the human beings. Then, on the other hand, as we like to say, our friend Larry Swedroe cites another study. He looked at the rise of quantitative funds. These are funds run by algorithms and computer model, have led to people asking, should I use the machine or should I use the human? There's a new study out that said, do machines beat humans? Evidence from mutual fund performance persist. They looked into it. The researchers looked into a long time, 20 years, 270 funds. And guess what they found? There isn't a clear winner either way. One doesn't do better. By the way, it's rare, they said, for either to persistently outperform an index. There's no evidence that the machine-managed funds consistently outperform the human funds or vice versa, and neither of them can sort of deliver that persistent outperformance, which is what we're looking for, right? I give you the money, make it more than the market, because if you've listened to the podcast for a long time, we're happy to accept what the market provides. And for you listening, you don't care because you have a portfolio, not a bunch of funds. You've got a plan moving forward, right? You're not out buying what's new and hot, and you don't suffer from FOMO, right? You're ignoring the latest thing, the thing that everybody's talking about. Things got to get it, whether it's the crazy stocks that have been out there recently, like Krispy Kreme, et cetera, and all this stuff drives me nuts. But don't put a donut hole in your portfolio. That's my take. So anyway, with that, Roxy Butner joins us, one of our advisors here at Appella Wealth, and certainly been on the program many, many times. Lots of questions. And how's your summer going, by the way? Been outside?
Summer's going well. Yeah, I've been paddleboarding a little bit, enjoying the sunshine that we really don't get a whole lot this part of the country. So it's been great, and I've been just kind of decorating my new place and meeting with clients here and there, and it's been good.
Good. All right. Well, let's get to the questions, which we have many of.
Mm-hmm. Some of these are going to be a little rapid fire, and then we've got a longer one.
You go. What do you got?
Okay, this first one is Jana Roberts, and from Columbia, Missouri. She says, I did a DIY investment for my granddaughter and was wondering what you think of my choices. So she's got a few Fidelity ETFs here, so I'll list them. FELC, 57%, FMDE, 11%, FESM, 11%, FDEV, 7%, FIGB, 5%, and SCHD, 9%.
Yeah, so I took the time to look into these funds. First of all, this is a lot of work. And you can buy one fund In many ways, you could buy a Vanguard Total, you could buy the Avantis Global Equity Fund, you could buy the DFA World Equity, DFAW, because the FELC, which makes up almost 2/3 of the portfolio, is what they call an enhanced large cap fund. So these are holding the stocks that have done the best, certainly recently, but over the long haul would not be the place we'd sort of, in your case, overemphasize. You've got a lot in technology here. There's some multi-factor stuff. There's some bonds in here too. I don't know why you'd want to have bonds for a college student in a Roth, because you really want to be all stock. It's a bit all over the place, but what's your take?
Yeah, so she said there's about $400 in there right now, which this does feel a little like overkill for $400. And not to mention, probably hard to track how these grow differently, what her overall allocation is going to look like. But I actually plugged them in, and it looks like the average weighted expense ratio, not bad, 0.19%. But she's really overweighted towards large. Like you said, that FELC, 57% is large blend. But then she also has SCHD, at a large value fund. So quite a bit of large, not a whole lot of international, no emerging markets, need a little bit more small for her age. And like you said, no bonds at her age.
Yeah, you really wouldn't want to have bonds for a college student. And I think this is really one of those great opportunities. You have one fund. It's all there. Again, the ones that I mentioned, Vanguard's got a very fine total global fund, and Dimensional and Avantis as well. Any of those would work fine.
And she does mention she has her, I don't know if it's a 401k, probably a 401k through Fidelity, and she has a Fidelity Freedom Fund 2025 in there, and she does not like it, which I'm not too surprised about. It'd be very, very conservative, a 2025 fund. These
You're probably looking at almost half in bonds in 2025.
So depending on her age, but also there's usually a pretty large cash drag on some of these target date funds, and the Fidelity Freedom Funds are not as cheap as you would expect for Fidelity. So,
all right, so there's one down, and thank you for the question again. One of the things I think people want to do when they manage money for others is they want to spend more time on it, make it more complex than it needs to be. With an amount like this, I just do the one fund and get on with it.
Yeah, absolutely.
All right, what else do we got? We got a lot of questions coming to talkingrealmoney.com. Keep them coming.
This is from Robert in Portland, Oregon. And he says, I have about $155,000 in the Vanguard Star Fund in my Roth. I'm going to dump it all and go ETFs, some Dimensional, Vanguard, etc. Should I sell 100% at once or drip sell and buy dollar cost average into ETFs of choice? Love your show.
Yeah, that's a great question. And the answer is you're already invested in one, the Star Fund. And if you're going to make a move, and I'd recommend it, I'm not a fan of the Star Fund, to these ETFs, which we do like, I just do it. I don't see no reason to wait around. That would be a market timing kind of situation. One of the mistakes I see people making often, too, is when they get into these situations, they have a hard time with the discipline. Like, well, I'm going to do that. Oh, God, but then the market went down. What do I do? So if your overall investment strategy is, just for sake of argument, 60% in stocks and 40% bonds, you want to make the equivalent move that over and reinvest so that your portfolio it matches that all the time.
The goal would be you're moving from a like investment to another like investment, right? So the Star Fund's going to give you some diversification. If you're targeting 60-40, great. If you build out your ETF portfolio, just make sure you're covering all the same asset classes, and then it should be, no issue. Try and get in and out as quick as possible. The one thing I will say, he did say he's got the Star Fund in his Roth, and so that is a 60-40 fund.
Yes, it is.
So I'm curious, if that's the only retirement savings that you have, that might make sense. But if you have other accounts, you might want to put more bonds in those other accounts and leave the Roth a little bit more aggressive.
And let's talk about that briefly. Again, the Roth grows tax-free growth. I know you're a believer in this because you're using it for your retirement. And it's a huge advantage, right? Because then you get to the days you're going to need to take the money out, take it out, and nobody's going to want their 20%. So I love the Roth. I don't love it for fixed income. I don't love it for cash. We had somebody come in recently that had a third of their money in cash in the Roth. If you got to have cash, you got to have bonds. Those should correctly, as you pointed out, most of the time should be in the qualified money, like a traditional IRA or 401k. Could also be in the taxable account. But the Roth really should be reserved for all those stocks. And in fact, the riskiest stocks like emerging markets of value, those things, because the growth expectations are greatest. You get that growth tax-free. It's a wonderful advantage.
I agree.
Wait, we got more questions?
We got more.
We've got more questions. Keep them coming.
This is from Michael in Pennacook, New Hampshire. And he says, hi, each year I put some money in a traditional IRA. My taxes were somewhat lower if I did so he gets the deduction. When I did my 2024 taxes, I found that I couldn't take the deduction. I started collecting Social Security and I'm still working. My income was too high as a result.
Okay, I'm going to stop you right there just real quick. I ran into this the other day where somebody's still working and they started taking Social Security, and my question was, why? Do you need the money? No, I think the fund's going to run out. Well, that's not a reason to take your Social Security. Absolutely 100% not. Will something get done? Yes. Do I know what it is? No. Can I guarantee that it will? No, but I can feel pretty close to that guarantee. So why would you take it? And by the way, I think you have 6 months to give it back, right? And if you decide change your mind, give it back, give them their money. You might look into that, because if you didn't need the money and you already have the income, I just keep working, get the income, and not mess around with it. But anyway, that's a quick aside.
Yeah, this could be a situation where he's 70 and still working.
Yeah.
And so he had to take it.
That could be true.
But let's see here. So can I move what I contributed to a traditional IRA for 2025 to a Roth IRA? I didn't appreciate the value of the Roth IRA until recently. Better late. Thanks.
So he's wanting to know, can you do the backdoor Roth IRA, basically?
I think...
Because you'd be putting it in non-deductible IRA and then moving it over to your Roth IRA.
Yes, or it could just go in as a regular Roth IRA contribution if he qualifies.
But it sounds like, yeah, so we don't know what his income level was, and I forget where the phase-out begins now. For a single person, it's $180,000, I think, a year or something, maybe less. I don't know.
So I think single filer is $150,000.
Okay.
It's very possible that he's under the threshold for the IRA deduction, or over it for the IRA deduction, but under it for the Roth IRA contribution.
But that's something you want to look into. By the way, if you also, a thing to think about with the back door, where you're taking the money that you put into the non-deductible IRA and then moving it over to the Roth, if you have money in an individual retirement account, you're going to have to move that pro-rata and pay tax on it. It gets kind of messy, so maybe you're not a good candidate for that either. I mean, this always gets back to the question of where to save for retirement. If you're working and you say you're working and you have a 401k plan, maybe it makes most sense to fill that up first. And if you did fill it up, then you could do the non-deductible IRA. But if your income is low enough, then you could do the Roth. So there's a lot of moving parts here.
Yeah. And you should just reach out if, I don't know where it's held. He doesn't specify. But if it's at Vanguard or Schwab, for example, they have what's called a recharacterization form. You just reach out to the custodian, let them know that you didn't qualify for the contribution, and they can recharacterize it as a 2025 Roth IRA contribution if you're eligible, or like Tom said, do the back door.
Yeah, this should be fairly straightforward, Michael, but and I would start, by the way, looking at that Social Security again. The only reason, as you said, is if you had to take it if you're age 70. There's no reason to wait after 70, by the way. You're just not getting your money that's coming to you. But other than that, if you had the income you needed from your place of work, I would not be taking Social Security until age 70. I mean, well, at least full retirement age, and only then if you need the money, if you're still working. And by the way, I'm past full retirement age, and I'm still working for a while anyway, till noon today. And then we'll see from there. So, but that you got a little planning work to do here. But I what you're saying is, yes, you could move that from the traditional to the Roth.
Yeah.
Yes.
And worst case, you also can just have them remove it altogether and you can put it in a taxable account.
That's true. Yeah, you could do that as well. Lots of questions coming to us from talkingrealmoney.com. You can go there, send them in. You can read them. You can call us on Saturdays live at noon Pacific, 3 Eastern. We want to try to get you the help that you need. By the way, Roxy talks to people, a lot of people from the podcast. So if you'd like to talk to her, you can go there and fill out the form and do that as well. Mm-hmm. But let's keep going with the questions. We've got a few that are fairly lengthy coming up here.
Yeah, so this is another kind of shorter one. It's a caller from Mount Airy, North Carolina. And they ask, if I have the dividend set to not reinvest, am I messing up the favorable tax treatment you have started for the ETFs? The reason I had it set that way was to use the dividends to buy more of the ETFs I have with smaller balances and gradually achieve a different mix. However, I noticed a relatively large cash dividend at the end of June and wondered if it would not have counted as a dividend for tax purposes if it had been reinvested.
All right, so let's be clear about exchange-traded funds. The word, so it's different than a mutual fund. An exchange-traded fund is held in like a warehouse, right? There's all these people that have this money. It is kind of, and then you've got this stock over here, and you want to unload it. You simply walk over and hand it to the other party, so there's no taxable gain there, capital gain. That's the part that they give the advantage. There's no advantage when it comes to dividends. You're going to pay those whether you cash them out and spend them, whether they get added, whatever happens to them, whether it's in a mutual fund or an exchange traded fund, or by the way, just if you held the stock, those dividends are going to be taxed. So there's no real advantage there. It's simply around capital gains. They have a huge advantage, and that's why we believe exchange traded funds really should be used absolutely 100% in taxable or brokerage type accounts.
Mm-hmm. Yeah. And to answer, your question, the cash dividends, as soon as you receive the cash dividends, which you can't really control, you are taxed on it. So whether you reinvest them or leave them as cash or use them for another purchase, they're already been taxed on it. So if you want to take that and reinvest into other ETFs, you can.
Yeah, I think that's, and by the way, this is something that's a little confusing to people around exchange-traded funds. But again, the key here is the capital gains, not the dividends. There's no way around paying tax on dividends that I know of. Maybe you got some super secret offshore account or something. But otherwise, you're going to pay tax. Yeah. Great question. And we've got time for another one here, right?
I think this is our last one.
Okay, ladies and gentlemen, those of you playing from home, you can start smiling because we only have one more question left.
This is a little bit longer, so bear with me. This is a caller from Woodstock, Georgia. My wife and I are currently 69 years old. We currently have a monthly income of U.S. Air Force retirement, $4,500, combined Social Security income of $2,684, rental income of $9,200 gross, and part-time job of $3,000 for a total of $19,384 per month.
Wait, you're making $250K a year as a retiree? First of all, thank you for your service in the Air Force. And by the way, we're recording this on my dad's 100th birthday, and he was a proud member of the Air Force. But that's a great income in retirement. Congratulations.
Mm-hmm. Well, he does have that part-time job still, so he's kind of
good for you.
Semi-retired, It sounds like. We are completely debt-free, house and all, with a rental real estate portfolio of around $1 million and paid-for house valued around $525,000.
Now you're just bragging. Okay, keep going.
In addition, we have around $500,000 in a self-directed, combined self and spouse IRA.
All right, so let's just stop there for a moment and unpack self-directed IRA, which would be different than an IRA at a traditional custodian, a Schwab or Fidelity or something like that. This is where you can start doing some specialty stuff, like it's usually, when I see them, real estate, et cetera, they're usually more expensive. It's not something we recommend. I'll put it that way.
Yeah. Alternative. It's an IRA where you can put alternative investments. You need to go look for a specialty custodian who will do this.
That always charges more, et cetera. So, yeah.
Okay. And within that self-directed IRA, he's got 50% in real estate, which is land, that generates $3,500 monthly income, and cash in CD. Plus, in Roth IRAs, about $400,000. We are currently investing an additional $16,000 per year into the Roth IRA account, so they're maxing out for both of them.
That's awesome.
Plus stocks of $145,000, increasing about by adding $1,100 per week,
which is great. Again, so far, other than the the self-directed IRA, I'm liking where we're going. Now it sort of takes a turn to the dark side. Speaking of Darth Vader, yeah.
So $550,000 in precious metals.
That's like gold, silver, that stuff. Yep. Mm-hmm.
And around $750,000 in crypto. Plus $250,000 in cash within CDs.
By the way, so just even right there before we get too far, you got a teeter-totter portfolio here because you got crypto, which I consider very, very, very high risk, and then cash on the other side. Like, let's get something in the middle to balance things out a little bit.
And he doesn't specify what the $145,000 in stocks are invested in, or the $400,000 in the Roth IRA. So that's a little unknown. He does say we do not own any bonds. We have around $500,000 in term life insurance that will stop in 3 years. We live well below our means with needing only $6,000 per month to live. I plan to stop working in 2 years, so part-time income will go away. And then he has a series of questions. So let's start with the first one.
Yeah. All right. What do we got?
Do I need to hold bonds?
Yeah. So, okay. But then this is the time to unpack this portfolio a little bit. It looks like it's about $2.5 million, somewhere in there.
Yep.
Not including the real estate. I had $500,000 in the self-directed IRA, which is probably going to be higher risk than I like because these are usually, as you said, alternative private real estate deals. Mm-hmm. You got the Roth, you got $500,000 in precious metals, you got $750. When I did the percentages, looked like about 30% of the portfolio is in crypto, which I consider pretty high risk. I mean, for all the reasons that we've stated numerous. So here come the haters. So that's risky. 10% in cash, and then 23% or so in precious metals, which is, again, not as risky a proposition, but certainly one where it can go for a very long period of time without making anything. So, but here's the way I would work on this if it were me, because you ask about bonds. The answer we're going to tell you is we don't know because we don't know you. We don't know what you're trying to do. I have no idea why you have all this money in crypto. I have no idea why precious metals. I'm getting an idea here that maybe that's because you don't trust the government or something. I don't know. But so I would first stop to figure out the bond to stock or the bond to crypto, whatever it is, to sit down and say, what am I trying to do with this money? Am I trying to be the richest man in America? I got bad news for you. That's not going to happen. So set that aside. Then I'd say, what rate of return am I trying to achieve and how much volatility are you willing to accept? Because having 30% of your money in crypto, you're going to need to expect massive amounts of ups and downs, hopefully more ups, but who knows? That would help me determine how much you should have in bonds versus stocks. I mean, what's your takeaway here?
Yeah, I kind of like to look at things from a backward approach. So you said that you spend about $6,000 per month. So that's about $72,000 per year is what you're estimating for expenses. So you have $250,000 in cash in CDs. That's could be 3 years of expenses if your pension and your Social Security income magically disappeared. But with your pension and your Social Security income, that's actually enough to cover your monthly bills from what you're saying here. So it really is a question of how much do you plan to tap into any of these investments? And then based off of that, you can kind of, like Tom said, determine what is the rate of return that you're looking to get, how much volatility can you accept. There's a lot of moving pieces here.
It always gets back to planning. I mean, this sounds like, again, this isn't a pitch, but the plan would be the first thing. Then you'd get into where all this money is. We could argue with you about being in crypto and precious metals, et cetera, but you could argue about how risky you want to be because the money's going to be left for my kids and grandkids or whatever it is, because you're never going to spend this, it doesn't sound like to me, with all this regular income you have. That would be one big takeaway. I'd be trying to talk to you about estate planning, like this money's going to be for charities, it's going to be for whatever it is. So the short answer to question one is, I don't know. I'm sorry. I'd love to help.
Yeah. And then question 2, what happens when we turn 73 and I'm required to take minimum distributions from the self-directed IRA? How will that affect my taxes?
Well, it'll make them worse. But so let's just assume he said 550 in the self-directed, right?
He said, $500,000 in the self-directed.
So that looks like that's going to be about $20,000 a year, the first RMD, assuming it doesn't grow a whole lot in value in that period of time. So that'll just be income of another $20,000. You don't have to spend it, but you're going to have to take it out of there, which is always trickier too with the self-directed from what we've seen. And so you're going to have to take it out. You're going to have to pay tax on it. There's no way around that, with the possible exception of doing a conversion, which I don't know how you do that.
I don't know.
With the self-directed, it gets to be very tricky.
You can. I mean, they really do operate tax-wise just like a regular IRA. But it gets complicated because it's difficult you have to have value assigned to all of the assets within that self-directed IRA. So
Correct.
You need that fair market value assessed every single year. And from what I read, if you don't do a good job of reporting the fair market value, which it sounds like you need sometimes third-party appraisals if they're real estate assets, you could get penalized quite a bit by the IRS.
Yep.
Because they need that to determine what your RMD is going to be. Not to mention, if you don't have liquid assets to pull from and move out of the self-directed IRA, you're looking at either having to sell real estate.
That's right.
or transfer deeds from the self-directed IRA to, it becomes very,
For reasons I don't understand, other than you think you're going to make more in that real estate deal than you'd make in a real estate investment trust, for example. So that's why they wouldn't be items of ours. But back to your question, you'll have to take an RMD. At the year you turn 73. And yes, you're going to have to, the first year is about 3.5% or so that has to come out. Whatever tax is due on that, got to hand it over.
Yeah. And then the third question sort of relates to the same thing. It says, what happens when we both pass away and the self-directed IRA that contains land, real estate, is inherited by my children? So do they have to liquidate the land to pay taxes?
Well, they're going to have to, the 10-year rule will apply. In other words, if an inherited IRA non-spousal, if they give it to your spouse, she can add it to her own holdings. She gets they're going to change it to whatever her expected lifetime would be. But for your kids, they're going to, the 10-year rule applies. You have to start taking that money out, paying the tax on it. Again, the complication here is this self-directed IRA. I don't know how they generate the money for that, because in my take, it's got to be emptied out at the end of the 10 years. So the land would have to be sold, and you'd have to have the deed, as you said, whatever it would be. It's complicated. So you're adding complication to your estate that I don't think you need to do.
And also, if your children are not aware of how to manage them, that can be very complicated for them, not to mention they could be paying more in IRS penalties if they don't, handle the fair market valuation properly.
Yep.
So but yes, they'll have to at least sell or move all the assets out of the IRA by year 10, just like with any inherited IRA.
That's absolutely 100% correct. So it will be harder than it would be from a traditional custodian. That I can almost guarantee from what we've seen. And the answer to your question is, they'll have to get rid of the land. I don't know how it's going to be complicated.
I would definitely have a conversation with them to prepare them for that if you don't plan on making a change.
And you're probably, with that complexity, you're going to need professional help, whether it be an advisor or CPA, somebody to walk them through how that's all going to work. So my personal take is I'd clean that up before you're gone.
Yeah.
But maybe you don't like your kids. You want to make it harder on them after you're gone. So here's a reminder that I'm still controlling things from beyond, something like that. So anyway, those are all the questions we have today. Keep the questions coming. We love to answer them. Roxy, glad to have you here instead of a machine. I just want to say, I'm going to put it out there. We were thinking about it. Should we just have the robot there? And we thought, no, Roxy's much better.
You just can't replace human interaction.
Exactly. I don't know. Well, hopefully that's true for you, not so much for me. It doesn't really matter. But yes, I hope you're right about that. If you want additional help for anything regarding your overall situation, you want it more personalized. In fact, this question should probably be taken up personally. You can go to talkingrealmoney.com and fill out the form, and we're glad to chat it up. So, Roxy, thank you for your time.
Thank you.
Keep up the great work with all of our clients.
Absolutely.
I will say this. I don't think I can give endorsement, but you get more compliments from all of our advisors than anybody else.
Oh, my goodness.
So, well done.
I don't know how to respond to them anymore. I'm just
say thank you.
Thank you.
Be gracious. Yeah. So thank you, and thank you, Roxy, and thank all of you for listening, for being part of this, and we're glad to be here every single day talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.